Welcome back to Investing Talk Podcast.
Today we're looking at Sigma Lithium. We're going to get into the core investment story here, their recent financials, some of the operational hurdles they're facing, and really how they're positioned in this global lithium market, especially with prices being so volatile.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For a lot of people, Sigma Lithium is, well, it's a story of two conflicting halves. I mean, on one side, you've got this stunning financial momentum that points to, some real underlying efficiency.
And on the other?
On the other, you have a massive operational miss that just screams execution risk.
Okay, so let's start with the good news then. Because those numbers, if you look past that one big miss, are actually pretty impressive. Tell us about Q3 2025.
Q3 was, well, it was a massive surprise in terms of efficiency. We saw revenues jump 69% quarter over quarter.
69%.
And 36% year over year. That's serious momentum. And this isn't just, surviving a tough market. This shows the actual business model can thrive. They managed to capture a 33% quarter over quarter price increase on their sales.
A 33% price hike in a single quarter is phenomenal. But, I mean, usually when you see that kind of growth, a company is sacrificing margin to chase that volume. Did that happen here?
No, and that's exactly why the good news is so important. The real story was the efficiency gains they got from their Greentech Industrial Plant. We saw operating margins expand by a really robust 42% year over year.
Okay, 42%.
And net margins are even better, up 67%. When lithium prices are all over the place, that kind of margin expansion tells you the core operation is getting structurally stronger, regardless of all the macro noise.
Wait, hang on. If their margins are expanding that much, why did the street hit the panic button right after the report? Where's the disconnect?
That is the central conflict of the whole story. While the margins are fantastic, their quarterly revenue, the actual number, came in at $28.55 million.
Okay.
Analyst estimates were up around $70.54 million.
Wow.
That is a massive gap, almost $42 million, and it's the single biggest red flag. It just highlights this persistent operational execution risk that they absolutely have to overcome to gain investor trust.
Yeah, missing by nearly $42 million isn't a rounding error. That immediately puts a question mark over their ability to deliver volume consistently. So what's the plan? How do they fix this and prove the model can scale?
The focus now is 100% on proving volume delivery soon. Their immediate guidance for Q1 2026 is set at 73,000 tons of lithium oxide concentrate. The market isn't just looking at the number, though. It's looking for proof of a consistent, large-scale production flow.
And their long-term goal is even bigger, right? I mean, almost shockingly so.
Oh, yeah. The long-term ambition is huge. They're aiming for a massive 550,000 tons by 2027. If they can pull that off, the company's entire profile shifts. It goes from being a niche producer to a major global player.
That 550,000-ton figure is, well, it's aspirational, but volume only matters if you can produce it cheaply. And this is where the long-term economics get really interesting, right? Their focus on cost reduction.
Absolutely. They're projecting a radical drop in their all-in sustaining costs, or AISC. For listeners, that's basically the full cash cost to get the product out the door, all in. They project their AISC will drop to about $560 a ton in 2026.
Which is already pretty low.
And then it falls even further to just $500 per ton in 2027.
So if they hit that $500 a ton target, how does that stack up against the rest of the industry?
It puts them in the lowest quartile globally. I mean, you have a lot of hard rock lithium miners sitting comfortably above $700, maybe even $800 per ton. That kind of cost profile creates a multi-year earnings inflection point. It gives them this huge margin buffer.
Right, so they can make cash even when their competitors are losing money.
Exactly, even when competitors are underwater.
So great cost projections, but they're also spending heavily to get to that 550,000-ton capacity. Let's talk about the balance sheet. Are they financing all this growth responsibly?
Well, on the surface, their liquidity has improved a lot. They reported a cash balance of $21 million in Q3, which was up 42% quarter over quarter. Plus, they've got another $8 million in receivables. But what really helped was generating $31 million from final price settlements.
Unlocking old revenue.
Yes, essentially unlocking that cash.
And that kind of cash generation is huge, especially when you see so many other miners dealing with cash burn just to build out. So how are they using that money?
They are aggressively deleveraging, which is a big positive. Their short-term trade finance debt was cut by 43%. It's now down to $33.8 million. That effort to pay down debt really stabilizes the immediate financial picture.
But the liquidity picture isn't perfect, is it? We have to look past that nice cash balance and get into the weeds of the metrics.
That's where you need to be careful. You mentioned the metrics. So the current ratio, it looks pretty robust at 1.5. That usually tells you they have healthy short-term liquidity.
Because they have 1.5 times more current assets than liabilities.
Exactly. But the problem is that the current ratio includes their inventory.
Right, and for a miner, inventory is just lithium concentrate sitting on the ground. It takes time to turn that into cash. So when we look at the quick ratio, the picture changes.
It changes completely. The quick ratio, which strips out that inventory, is very low. It's at 0.32. For anyone who isn't an accountant, that 0.32 means that for every dollar of immediate bills they owe, they only have 32 cents in truly liquid assets, like cash, to cover it instantly. That signals some immediate cash flow pressure.
And you can see it in their debt structure too, right? The debt-to-equity ratio is high, almost 2.0. So even though they're paying down debt, the sheer size of it compared to their equity is something you've got to watch.
Yeah.
It means they're relying a lot on borrowing to fund those big expansion plans.
It does. But they have some clear ways to relieve that pressure. I mean, they can use prepayment deals and, most importantly, monetize that inventory. We're talking about a potential $33 million cash unlock from the, 270,000 tons they currently hold. If they sell that, that whole quick ratio problem just disappears.
That makes sense. They're literally sitting on the value. They just need to move it. Now, you mentioned capital expenditures are pressuring their free cash flow. Are they just burning cash to hit that big production target?
They are. Free cash flow is definitely pressured by the CapEx needed for the plant upgrade to 300,000 tons. But this isn't just, maintenance spending, it's strategic. They're reinvesting to target higher value products, specifically high purity middlings. That strengthens their whole revenue mix by getting them better margins on every ton.
Let's pivot to their core advantage. If execution risk is the problem, then the solution has to be in their unique tech and cost structure. What exactly is this green tech mode?
Sigma's whole edge is centered on its sustainable, low-cost Greentech plant in Brazil's Lithium Valley. This is what really differentiates them from, say, higher cost or less sustainable rivals in Australia or China.
Sustainable can be a bit of a buzzword, though. What specific things back up that ESG claim?
It's very tangible. First, they produce a high-purity concentrate, which already gets a premium price, and they've done this with 0 lost-time accidents. But the most important piece for the environment is they use dry-stacked tailings.
Okay, explain why dry-stacked tailings are so important.
So most miners use wet tailings. That means huge storage ponds, it consumes tons of water, and it's a huge environmental risk if a dam breaches. Dry-stacked tailings, on the other hand, conserve water and eliminate that dam risk entirely. This ESG differentiation lets them get premium pricing from buyers like EV makers who are under pressure to clean up their supply chain. It's a real moat that connects their ESG image directly to their bottom line.
So the fundamentals are pointing towards cost leadership, all driven by this unique green tech process. How is the market reacting to this complex story of huge misses and huge margin expansion?
We've seen some very bullish price action recently. I mean, the immediate reaction to the numbers was a massive 15.3% gap up. It pushed the stock to a new 52-week high of $15.13. That tells me that the great margin story is, for now, winning out over the execution risk. It's a signal that a psychological shift is happening.
But, I mean, it's a lithium pure play. The stock lives and dies by commodity sentiment, so volatility is just part of the game.
Oh, absolutely. You'll see those sharp swings, like a 6.8% dip in the pre-market on some general lithium news. But what's really key is the quick rebound, like the 7.33% bounce we saw right after. That pattern tells you that technical support is holding because institutions are actively buying on the dips.
Let's talk about the institutions, the smart money. Ownership is high, right? Around 65%. And funds have been actively increasing their stakes. What are they betting on?
They're betting on the macro tide turning. I mean, the stock really took off recently after Scotiabank put out a forecast for a multi-year lithium price surge, projecting tightening supply all the way through 2028. Institutional money is clearly getting in position for that cycle change. They see Sigma as one of the best, pure play ways to ride that wave.
Right. So when you hear that forecast, you should see it as institutions saying the whole lithium tide is about to rise, and Sigma is like a well-built canoe waiting for the flood.
That's a great way to put it.
So the next few months are critical for them to prove themselves and validate those institutional bets. What's on the immediate calendar? The catalyst calendar, as you call it.
The market is going to be laser focused on the Q4 2025 results. They're probably due late January, maybe early February 2026. But the real test, the one that matters, is whether they hit that Q1 production target of 73,000 tons. If they deliver on that volume, it basically puts that $42 million miss to bed.
And what other events could move the stock in the near term?
Well, we're watching for the closure of some of those big offtake agreements they've been talking about. Also, the first sales of those high-purity middlings that would validate their premium product strategy. And, of course, executing that inventory monetization. That potential $33 million in cash is key to fixing the short-term liquidity issues we talked about with the quick ratio.
Okay, we always have to keep things balanced. What are the biggest risks? What's the bear case that would keep a conservative investor on the sidelines?
The top risks are all about execution. And they're significant. First, there's just the continued threat of operational delays. We still need total clarity on when mining operations will be fully back at max capacity. And there are still some worries about Q1 production volumes, given their history of under-delivering.
And the second point.
The second is those weak historical fundamentals that some critics point to. You know, even with this recent expansion, they point to the really negative historical margins and those huge revenue misses as signs of sort of underlying instability.
That seems fair. But how are these risks being managed?
I think you have to see them as partially managed. They've already generated that $31 million in cash. They're actively paying down debt. And they have this huge tailwind from rising lithium prices. If that macro trend holds, these operational risks become temporary headaches that give you a good entry point, not existential threats.
So let's wrap this up. If you're giving someone the elevator pitch, what's the one thing to focus on? We have great long-term economics versus this persistent short-term delivery risk.
I think the focus has to be on the ultimate destination, the Q3 performance, the expanding margins, and that future cost projection dropping all the way down to $500 a ton by 2027. It all positions Sigma Lithium as a high-conviction recovery play. The whole idea is driven by that expected multi-year tightening in the lithium cycle.
Right. So you can look at this in two ways. It could be a swing trade where you're targeting proof points like Q4 earnings or really that Q1 production number in the next 1 to 3 months. Or you could scale into it for a multi-year hold based on that fundamental lithium cycle shift.
At the end of the day, the story is about institutional accumulation, creating a contrarian opportunity in the middle of all this short-term negative noise. The market is kind of ignoring today's bumps because it sees the promise of tomorrow's cost structure, which is then amplified by that massive potential scale up to 550,000 tons. That's the real long-term game changer here.
If you want more analyses like this delivered straight to you, make sure you hit that subscribe button.